Welcome everybody, I'm Andrei Knight. This is Fibonacci Fridays. How you guys doing? Bit of a rough and choppy week out there. Did you guys make it through okay? Today we're going to look at gold because it's been moving a lot. Or how much further up, for that matter, right? This week was more up than down. Is this thing crazy or what? It falls, it falls, it falls, just as everybody says it's the end. Look at the length of this wick. Man, I would have hated to sell down here and get impaled on this. So is the move done? The move down done? How much further can it go up? These are the sorts of questions I'm going to help you answer today, you guys. And I'm picking on gold just because there's an interesting story here and because I've been trading it a lot lately. I like to use real-life examples. But I want you to know that the techniques you learn here today, you can use on any instrument, gold, forex, oil, stocks, whatever you like. You can use it on most any time frame. As I'll show you in a little bit, Fibs scale really well across time frames. And best of all, you can combine it with whatever tools and indicators you may be already using, you guys. You don't have to stop doing what's been working for you to this point. This is simply another tool that you can add to your toolbox. It plays really nicely with other systems and other indicators. Okay? So let's see how this is done. First of all, I want to show you what got my attention with gold and what brought us to this point. I'm going to throw a couple of trend lines on here. And all I'm going to do, you guys, is I'm going to connect the two tops, body to body. Okay, with trend lines, I'm looking to find points of consensus. So I go body to body. Wicks represent extreme prices that the market's tried and then rejected. Okay? Bodies are kind of the consensus points. So for this purpose, trend lines, I'm going body to body. As you'll see in a moment with Fibs, because we're measuring distance, I like to go wick to wick. Does that make sense? Consensus, body to body, distance, wick to wick. And I'm going to put a similar trend line here across the bottom. Again, just body to body. Now, this is a monthly chart. I'm starting with a very, very broad view. So you can see what brought us to this point. And already you notice something really interesting about April's candle, don't you? This was the month. We had previously found support on this line 3 times. April is the month we broke below. And not just broke below, but as I begin to zoom in, look at this. You can see that the moment we broke this line, notice how small the candles are leading up to it. Notice the moment we broke it is when these bars started getting longer and longer and longer. In other words, the move down started accelerating. See that? It was the moment we broke this line. We're on to something here. If I zoom in even closer on the hourly chart, look at how dramatic that is, hour by hour. while we're above this line, look at the size of the candles, once we're below the line. And now on the hourly chart on down, you notice something else interesting. We didn't just drop down right away, you guys. Very first thing we did was come back up from underneath and retest this level as resistance. This level that we drew on the monthly chart. Look at how the hourly chart is reacting to it. Probably going to have a hard time finding it, but it would be even more dramatic on the 15-minute chart. Now, that's going to be hard to find 15 minutes at a time, but you have to take my word for it. The more I zoom in, the more dramatic the interaction is around this line, which we technically drew a year ago. We would have had the second bottom May 1st, 2012. A year in advance. We knew what was going to be important to the hour this month. And all I did so far, you guys, was just draw two cleverly placed lines on my chart. We're just getting started here. What I hope to show you by the end of this session, you guys, is that market moves, even big, wild, and crazy ones like this one, aren't random. There is a method to the madness. And once you learn the method, you can apply it to figure out how much further most trends are likely to go. Which, if you think about it, is a key piece of information. Helps you decide whether it's worth getting in or not. How much further is it going to go? Helps you figure out how much longer to hang on for a target. Helps you potentially, whether you're in the trade, not in the trade, or losing money on the trade, figure out when it's going to end in reverse, so maybe you have an opportunity to get in the opposite direction. So either way, it's really awesomely useful information. Simply knowing where those reversal points are likely to take place. You know, like Chuck, you said it's going lower. I do agree with you, eventually it will. But wouldn't it be great to know how much higher it might go before it turns back down and goes lower? And then how much lower it's going to go before the downtrend finally ends and the uptrend resumes. Because eventually, long term, the trend will resume back up. Believe me. People like gold. Okay, so I'm kind of predicting up in the short term, down in the medium term, and eventually back up in the long term. I don't think people will lose their fascination with gold. I don't expect governments around the world are going to stop printing money anytime soon. The more quantitative easing they implement, no matter what they call it, the more valuable they make gold in the long term. Elemental one, great question. Are fibs to be drawn on the highest time frame? Let me say this. I always do my analysis starting at the highest time frame on down. Meaning every month, May 1st of every month, I look at my monthly charts and take some notes if I'm near any key levels, important levels. Like, for example, in April and also March being close to this line. The start of every week, Monday morning, I study my weekly charts. At the start of every trading day, I start my daily charts. And then, having that big picture in mind, and only then, do I zoom in on my primary trading time frames. Okay, and I like to use two. I use a higher time frame for direction, and in a lower time frame for specific timing out of entries or exits. Do I pull the trigger here, or do I wait one more candle? That I do on the hourly chart. But whatever time frames you trade on, you could be a scalper trading on the 1 minute or 5 minute chart. Your win rate will go way up if you combine it with a higher time frame. Establish the direction first. You shouldn't always be looking for entries in either direction. You should be a bull or a bear, waiting to see if you have an entry in that direction or not. But the direction you should change from one time frame higher up. And I should mention the best spacing for time frames, while we're on that subject, 4 times to 6 times apart, you guys. That's the sweet spot. I've noticed if your 2 time frames are too close together, you will almost always get conflicting signals and information. And if your time frames are too far apart, you risk them not having relevance to one another. Okay, so shoot for a factor of 4 to 6 apart. What do I mean by that? If you're on the 1 minute chart, 5 minute chart is your higher time frame. If you're on the 5 minute chart, the 15 minute chart is too close together. It's only 3 times more. So if you're on the 5 minute chart, use the 30 minute chart. See what I'm getting at? If you're on the 15 minute chart, skip the 30 minute chart, use the hourly chart. And so on and so forth. Shoot for 4 to 6 times apart. That ratio is more important than which time frame you use. Though I will tell you, if you're having trouble on the 5 minute chart, it doesn't get easier on the 1 minute chart. The lower down you go, the more noise there is, the more often you're going to be wrong. Simple as that. And when you're right, the less pips it's going to be before the next reversal. Unless you have several months of consistent track record behind you, I wouldn't even recommend looking below the hourly chart, to be quite honest with you. Otherwise, you're fighting an upstream battle. Oh, I'm going to stay on the 1 minute chart, and as soon as I start winning and getting this stuff, I'll peek up at the 5 minute chart. You're doing it in the reverse order. Work top down, people. And you will find yourself much more often on the correct side of the trade. Well, scalpers just like to click things a lot. They don't necessarily make more money. I know a lot of scalpers, elemental ones, and the best ones almost break even. But they work a lot harder than the rest of us. Just FYI. If you want to drive the gold Mercedes, stick to the hourly charts on up. So back to your question about time frame, I do my analysis top down. Wherever I see a zigzag is where I draw a fib. Okay? So I may see one on the monthly chart and draw one. I may not. I may find one on the weekly chart and draw one, or I may not. I just work top down, and I put in the fibs where I happen to see the zigzags on the way down. And you'll see me do it on a couple different time frames here as we go along. Okay, so let's start with fibs. The first thing I want to measure, you guys, is the uptrend that got us to this point. Okay, so I'm simply going to go to the most recent low. I'm going to label that point A. Remember, we're going wick to wick because now we're measuring distance. And notice I didn't pick the lowest low, you guys. I picked the most recent low. Okay? Not necessarily the lowest. Sometimes it's one and the same. But I'm interested in the most recent low much more than I am the lowest low. And then point B, that's going to be the topmost point we reached before we started down. Again, the wick. Okay, that goes more like that. And I'm going to reach for my Fibonacci tool, you guys. I'm going to go down at the bottom of the wick by point A. I'm going to click. I'm going to hold my mouse button down, not letting go, dragging up to point B. And by the way, if you want to double check to make sure you drew your fib precisely, the red dotted line, if you're using MetaTrader, represents how you drew your fib. Double click on that red dotted line, and you're going to get these little white squares at each end. You see that? And then here you can click on the handle and let go, and it'll snap to the closest nearby wick. So you can be sure you have exactly the right points. Well, gee whiz. Look what's going on here already. The next thing you'll notice, look at on the way up, for example, these bodies resting right on the line. Or these bodies resting right under it. This is where we found resistance. We came down. Notice this wick, we found support. That's where we sprang up, broke resistance, and eventually established that level as the new support before we went on to the next level. These points, and they can be bodies like this, or wicks like this, but I call these snaps. Okay, you have control over 2 points, A and B. You can't really control where the in-between lines are going to fall. And if the in-between lines happen to fall at important steps on the way up, bodies or wicks, you know you've got the right fib. Okay, snaps equal validation. If you don't see a lot of snaps on the in-between levels, try redrawing your fib. Maybe there's a nearby A you can try, or a nearby B. As we go up here, look at this, you guys. The body right now is hovering a little bit above 38.2. Look where the wick came down to before we bounced back up. Okay? You should already see this move down was no random accident. Oh, okay. You got my attention. I'm glad I stuck around. It's going to get even better, you guys. We're just getting started. First of all, to all the people that were panicking and saying this is the end of gold, I've got news for you. Statistically, gold retraces at least 50%, and very often 61.8% before it moves higher. You can go back and study the history of gold all the way up this rally, and you'll notice before each big push up, look at the move from here to here, for example. And look at the retracement down before this multi-year run up. This pullback was 61.8%. It was shallower, statistically and relatively speaking, than this one is. So what's all the panic about? Those of us that have been trading gold a while know this is exactly what it does. And 50 to 61% is average. That's not even a deep pullback. That's average. What is the effectiveness elemental one? Well, keep paying attention. You decide by the end of this webinar. Remember, I'm not finished yet. I'm just laying the framework. And that is true, Andreas. Most of the time, I would add to that also 38. Not for so much for gold, but for Forex. It's usually 38, 50, or 61. That's like 90% of your retracements. Okay, and basically Fibonacci boils down to this. If you measure A to B, and then observe where C is, you can trade C to D. Okay, C being the pullback, how far back towards A we came. 50% simply means halfway between A and B. Make sense? So we have some rules based on where C is, where D is going to likely be on the extension. You'll notice if I shrink this down, all the numbers above 0, or in other words above B, are bigger than 100%. Because these are now the Fibonacci extensions. These are the Fibonacci retracements. How far back towards A did we come? How far beyond B did we extend? All I'm doing with my fib levels, a lot of people say, oh, well, your fibs look different than I've seen them before. All I'm doing is I'm plotting retracements and extensions with one tool. Okay? A little shortcut, if you will. Normally it's two separate drawing tools. And I've got a text file that'll help you set up your fibs to look exactly like mine. There's a PDF document if you go to that link. There's a PDF document, and it also summarizes the most common C to D rules on that document. The three most common ones: if C retraces to 38, your D will extend to 138 most of the time. If you retrace to 50%, your D is going to extend to 161. If your C retraces to 61, your D more often than not will also go to 161. Okay, so that's the three most common ones. The lesser common ones, now this is on the document, but just as an FYI, if we retrace to 78, now the fear starts to overpower the greed. Usually retracements of 78, 50% of them will just go to 0 and stop. In other words, a double top. So what I always do, I split this one up. I always get out at 0, because sometimes when you hit the prior top after a 78 retracement, you get a sharp bounce back down. It happens quickly. So I'll get out. If I break above it and retest it from the other side, here's that retest again. Very important, you guys. A break alone is not enough. It must retest from the other side. If I break 0, retest as support, then as a second trade, I trade from 0 up to 161 on a 78 retracement. 86 will usually go to 0 and stop. Okay, so just a double top and no further. Your 23 retracements, these guys are an either or. Half the time it'll go to 118, half the time it'll go to 127. So what do you do in that case? Some people will exit half here, let the other half go to here. I personally don't like cutting winning trades in half. What I'll do is I'll set my pending order by the 127 to take me out. And always set your targets a little bit shy for safety, guys. Never put any pending orders right on the line. Always set your targets a little shy. Always set your stops a little bit wider. Never right at obvious levels. Okay, so I'll set my pending order right below 127, and I'll simply watch what's happening at 118. Are the candles getting smaller? Are my indicators starting to reverse? Do I seem to be holding this level as resistance? If so, then I'll manually close my trade at 118. If I blow past 118, I've got the pending order to take me out at 127. That's how I personally handle it. So a 23 retracement is an either-or situation, either 118 or 127. A 78 retracement is a first zero, then, if it happens, a 161. Okay, always two separate trades. So that's the movement rules in a nutshell. And if you see that we retrace to 50%, once the down move is done, it has the potential to go really, really high. 161, I can't even zoom out that far yet. Okay, the 138 is at 123.94. The 161 is up around 2,500. I know that because I've been talking about the 2,500 level since about 2009. As in 4 years ago. What we're doing now is finally setting up the mathematical proof that we can eventually get there. Eventually. But let's deal with right now and what's likely to happen over the next couple weeks. I'll show you how to figure that out. C can be a body or a wick. Dhruv, great question. It's the deepest point reached of the retracement. So sometimes it's a body with no wick, sometimes it's a wick. Whatever the deepest point of the retracement is, that's what it is. And it's, by the way, I should mention, you don't go to the closest, the thing you're closest to, you go to the last level actually touched or crossed. Okay? So if I was a few pips above 50, it would count as a 38. Even if I'm closer to here than here. Okay? So the last level actually touched or crossed. The retest, Mike, would be on my primary trading time frame. So maybe the hourly chart. Here's a rule of thumb. If you see a retest on a 1-minute chart, it's good for a trade lasting a few minutes. If you see a retest fully formed on an hourly chart, it's good for a trade lasting a couple hours. It's always a couple candles on the time frame you see it on. I wouldn't hold a trade overnight based on a retest on an hourly chart. But if I see a retest on a daily chart, that might lead to a multi-day trade. You see what I mean? So everything's relative to the time frame you see it on. As a general rule, I draw fibs where I see the zigzags. The retests and anything else, indicator confirmations, are on my primary trading time frame. And that's why I say fibs play really well with other systems. Draw your fibs when you do your daily top-down analysis. Trade on your favorite time frame with your favorite indicators in between those fib levels. Okay, because that's the cool thing. Fibs are time frame independent. I'm not moving my fib that I drew on the monthly chart. Look at how we're reacting to it on the hourly chart. See what I mean? So you can draw it on one time frame and trade it on a totally different time frame. Let's look at the current move down, shall we? This last leg of the move down. Once again, I'm going to draw a fib, not necessarily from the highest high, but from the most recent high down to the most recent low. Okay. And notice this current retracement up that's been going, that stopped today. Look where that wick stops. Not in thin air. Not in random empty space. But right on a fib level. Yeah. Funny that, Arvind. So what do we gather from that? If there's going to be a second down wave, it would in theory go down to, see if you guys have been paying attention, 161. Good, Tim. So we simply shrink our chart down, take a look at where that is. 1155.42. And funny enough, look at this. The shorter term downward facing fib and the longer term upward facing fib that I drew on my monthly chart land in the same exact spot. 1155.42. So while some people are panicking thinking this is the end of gold, now you need a qualifying trigger, and how about for a qualifying trigger, because it's one thing to expect something. It's something else to see that it's actually happening, right? I trade what I see, not what I expect. So I'm assuming it's going to go from 161, or from 61, pardon me, to 161. And I love how both of these fibs land in the same exact spot. Usually it'll be in the same general ballpark, you guys, but I mean this is to the pip. That's almost spooky. Two different fibs from two different time frames. So how about if I trade when this double layer of two fibs gets broken as support and retested from underneath as resistance? That'll be the trigger to trade down to here. If we find support here and never have a close below it, well, great. I know where the next double fib is above me. I'll probably trade up to that level. And if that breaks, it becomes support to the next double level. But we'll deal with that one step at a time. If we break here and retest as resistance, I know exactly where I'm going based on our Fibonacci rules. I'm not panicking as gold drops further, in other words. I'm trading down to this level because I expect to be around this level. Why would I panic anywhere above it? This is all within the realm of statistical likelihood. And if the price comes down here and bounces, guess what? That is a buying opportunity. Because now gold is on sale. If this level doesn't hold as support and we break below it, that's when it becomes a selling opportunity. And why are retests important, Boyke? This must be your favorite question because you ask me this at least once a month. Because they double your chances of success. Statistically, 80% of all breakouts prove to be false breakouts. The ones that go and go are the ones that retest from the other side. Think about it this way. You know, if price is going up and up and up and up, you don't want to buy the top. You want to wait till it comes down for the retest. Right? Not only are you getting more confidence, but as it comes down, it's getting cheaper and cheaper. Right? Buy things when they're on sale. Don't walk into the gold Mercedes dealer and tell them, that's an amazing $40 million car. I'd like to give you $50 million for it because I like it so much. And I like you. I want both your kids to go to college. I'm going to pay for it. You wouldn't say that to a car dealer, so don't trade that way, you guys. Wait till it's on sale to buy it. Wait till the price is inflated to sell it. Retests are your best friends. Not only are you gaining more confidence in a sale price, realize that when something moves to retest, it's moving closer to your stop, which means you're going to risk less when you get in, and it's moving further from your target, so you have more to gain. In other words, your risk-reward ratio is changing exponentially in your favor by the moment. So don't jump the gun. Usually on a big move like this, Yano, after such a big drop, usually we expect a double bottom. So I'd say at least twice. Retest, very simply, Dhruv, if we break a level, you'll see it on some of these lower time frames. Normally what happens, notice here like we found a ceiling, right? We bounced off of this particular level as a ceiling. Here we did it again. Notice when we finally broke this level as a ceiling, we didn't right away go up, 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 and away. The very first thing we did was come back down and now establish it as the new floor, and then push up off of it. That's a retest. So what I'm saying is, don't buy the tops right before it starts retracing down. Wait for it to retrace down. If you're buying, buy the bottoms, as long as it's above this level. The moment you go below this level, you're a seller, you're not a buyer anymore. You see what I mean? If you're buying, you want to buy as close to this level as you can, but above it, and preferably after a bounce. See what I mean? That's your highest probability of success. Okay, so anything that breaks should retest from the other side. And yes, Arvind, it has, hasn't it? As a matter of fact, let's look at the 15-minute chart. Look, we're retracing back up. Guess what we're going to do? Before we go lower, we're going to test this level from underneath as resistance. Okay? So to recap, I'm waiting to see if this level breaks, this double Fibonacci level. If it breaks, will it retest from underneath as resistance? If so, and if we establish a new ceiling down here, I've got a nice trade of almost $200 an ounce. No, sorry, $300 an ounce. From 1447 down to 1155.42. And if it looks like I'm forming a double bottom at 0, or if I can't get past this longer term fib, if I get a bounce up here, fine, I'll take my profits here. And I can always get back in if this level breaks later. Okay, and you can see the same thing. If I find support here, I'm going to trade up to this level next. See, this is one way bank traders win much more often, you guys. They don't put themselves in a I can be right, I can be wrong situation. I'm ready to profit if it goes up. I'm ready to profit if it goes down. See what I mean? I put myself in a I am right or I am right situation. It all depends on whether I find a floor this week going into Sunday night's open. It all depends if I find a floor at 1455 or if I find a ceiling at 1447. That'll tell me what to do next week. And after next week, I'll decide what to do the week after that. But I'm covered, as you can see, both short-term and long-term, both on the way down and on the way up. Whatever gold is ready to do, I'm ready to take advantage of it and make a profit on it. That's how institutional traders think. And that's Fibonacci trading in a nutshell, you guys. Here's my Twitter and Facebook, if you'd like to stay in touch. If you want to learn the entire system, I did the best I could to give you as much information as I can inside of one 45-minute session. If you want to learn my entire trading system, including which indicators I use in combination with Fibs to confirm their signals, how do I time out an entry, how do I know how many lots to use, money management, psychology, I've condensed everything I've learned about trading over the years into a series of pre-recorded workshops that you can watch at your convenience. Okay? Or, if you found today helpful, imagine starting and ending every trading session together. 2 classes a day, 10 classes a week. Because that's what we do in our pro room. We do analyses just like this one. We set up our trades across all commodities and currency pairs in the morning. And then we get back together again at the end of the day and see what worked, what didn't, and what we can fine-tune for tomorrow. That's what we do in our pro room. And a whole month of trading costs less than a typical losing trade. Just FYI. But if you're on a budget, and we record all the classes, by the way, so it doesn't matter what your time zone is. You can also watch when it's convenient for you, if you don't want to be in the live sessions. But if you're on a budget or on an extremely tight schedule, we have what we call our weekly video updates. That's the third link I posted. Here we just send you the Monday morning recording every week. Why Monday morning? Because that's when we set up our trading plan for the week ahead. Okay, think of it as the digest version. You don't get to interact, you don't get to ask questions, but hey, it's £29 a week. Or pardon me, £29 a month for a trading plan to last you the whole week, every week. And at the very minimum, you guys, please stop by fxnight.com. Lots of free resources on the website. The only thing I really charge for is my time. Okay? You'll find plenty of free resources, training videos, chat room, forum, streaming news, plugins for MetaTrader, all sorts of goodies. Okay, so stop by, see what you can do to improve your trading. And at the very minimum, take a moment to fill out my mailing list. Okay, I'm not going to spam you. I send out maybe 2 mailings a month, if that even. And usually it's to invite you to another free webinar like this one. Okay, so I do hope we'll have the chance to work together again. I'm teaching institutional trading strategies next Wednesday here on FX Street. And until then, you guys, I wish you good hunting. Pull up a couple of your favorite pairs and time frames. Look for a zigzag as you do your top-down analysis. Draw a fib. Prove to yourself that this works. You don't have to take my word for it. So good luck, and I'll see you guys next time. Cheers.